Hello everyone, welcome back to the channel. In today's video, we're going to break down one of the most important financial statements in accounting, the cash flow statement. If you truly want to understand how a business survives, grows, and avoids bankruptcy, you must understand cash flow. Because here's the truth. A company can show profit and still go bankrupt. But a company with healthy cash flow can survive even during tough times. So in this video, I'll explain what the cash flow statement is, why it is important, the three major sections, the difference between profit and cash, and how to interpret it properly. Let's begin. 1. What is the cash flow statement? The cash flow statement is a financial statement that shows how cash moved in and out of a business during a specific period. It records actual cash received and actual cash paid. Unlike the income statement, which is prepared using accrual accounting, the cash flow statement focuses strictly on cash. It answers one simple but powerful question. Where did the cash come from and where did it go? At the end of the statement, we see beginning cash plus net increase or minus decrease equals ending cash balance. This ending cash must match the cash figure in the balance sheet. 2. Why is the cash flow statement important? The cash flow statement is important because it shows liquidity, the company's ability to pay short-term obligations. It reveals financial strength beyond accounting profit. Investors use it to evaluate sustainability. Lenders use it to assess repayment ability. A company may report high revenue, but if customers haven't paid yet, there is no cash. Profit does not equal cash. For example, you sell goods worth $100,000 on credit. Your income statement shows revenue. But if customers haven't paid, your cash hasn't increased. That's why the cash flow statement is critical. 3. The three main sections. The cash flow statement is divided into three major sections: operating activities, investing activities, financing activities. Let's break each one down. Operating activities, core business activities. This section shows cash generated from the company's main operations. Examples of cash inflows: cash received from customers, cash receipts from services. Examples of cash outflows: cash paid to suppliers, cash paid to employees, cash paid for rent, cash paid for taxes. Operating cash flow tells us, is the company generating enough cash from its core business? This is the most important section. If operating cash flow is consistently negative, that is a warning sign. Even profitable companies can collapse if operating cash flow is weak. B. Investing activities, long-term assets. This section shows cash used for or generated from investments in long-term assets. Examples: cash outflows, purchase of equipment, purchase of buildings, purchase of vehicles, buying shares of another company. Cash inflows, sale of equipment, sale of investments. If investing cash flow is negative, it may not be bad. Why? Because it could mean the company is expanding and buying assets for growth. Context matters. C. Financing activities, owners and lenders. This section shows cash transactions involving owners and creditors. Cash inflows, issuing shares, receiving loans. Cash outflows, repaying loans, paying dividends. This section answers, how is the company funding its operations and expansion? If a company constantly borrows money just to survive, that may signal financial weakness. 4. Direct versus indirect method. Under IFRS and most accounting frameworks, companies can present operating cash flow using direct method, indirect method. The direct method shows cash received from customers, cash paid to suppliers. Very straightforward. The indirect method starts with net profit, then adjusts for non-cash items like depreciation, changes in working capital. Most companies use the indirect method. Why? Because it connects profit to cash. 5. Relationship with other financial statements. The cash flow statement links directly to the income statement through net profit, the balance sheet through changes in assets and liabilities. For example, increase in accounts receivable reduces cash. Increase in inventory reduces cash. Increase in payables increases cash. Everything is connected. That's why you must understand all three financial statements together. 6. How to interpret the cash flow statement. When analyzing cash flow, ask these questions. Is operating cash flow positive? Is the company relying too much on borrowing? Is investment spending reasonable? Is the business generating enough cash to pay dividends? Healthy companies usually show positive operating cash flow, strategic investing outflows, balanced financing activities. Conclusion. To summarize, the cash flow statement shows real cash movement. It is divided into operating, investing, financing. It helps us understand liquidity, sustainability, and financial strength. Remember, profit is theory, cash is reality. If you understand the cash flow statement, you understand the heartbeat of a business. If you found this helpful, don't forget to like, subscribe, and share this video with someone learning accounting. And I'll see you in the next lesson.